Hi, this is Jean Jo, broker and owner of Perisson Real Estate, and welcome back to another edition of Perisson Pulse. So we're a little over halfway through the month of April, and this is the time of the month when I'd like to do a brief market update regarding what's happened in March and other things that I've been seeing and what we're looking at just in the field. So that's what I'm going to do today. First is median sale price. And for those of you who've been watching my market updates, I always cover the big three that I always cover are median sale price, the months of inventory, and days to sell. So the median sale price has to do with the price at which homes that are selling above that number are equal to the homes that are selling below that number. This data is for single family homes in San Mateo County. Condos and townhomes do act a little bit differently, but similar, as well as our neighboring counties, San Francisco, Santa Clara, across the bay with Alameda County, and just in general, our peninsula, San Francisco and the peninsula, East and the Bay Area, tend to be very somewhat similar, but there are some differences depending on your locality. I'm here in San Mateo, and so I'm going to focus on San Mateo County. In terms of the median sale price, you'll see here the chart goes back to 2006. And you do see a little dip there that I've talked about before, having to do with that Great Recession that we experienced in 2008. And then since then, a steady increase. We see COVID lockdown that happened. That's that big red line that you see here. That is when in March of 2020, as I'm sure that date is burned into, that month is burned into all of our memories. We did have a little bit of a uncertainty or a lot of uncertainty as to where the market was going to go. It was a little bit, it stayed pretty much plateaued through that year. And then 2021, things just took off. So you can see that huge peak 2021 and the beginning of 2022, where in April of 22 was our all-time high at 2.25 million. Just boggles the mind, though, if you think about it. $2 million at a median sale price it really does boggle the mind, but that's where we were. Middle of 2022, we did see a decrease, a pretty sharp decrease over the course of that year due to the rapid rise of interest rates. We literally saw rates go double within the matter of 2 or 3 months. So where people had 3% went up to 6%. So all of you who've been keeping up have heard all of this. But in terms of, so where did we go from there? Well, last year, 2023, prices pretty much kind of came up again, stabilized, and you can see it almost looks like you could draw a little line through the 2023 year with the little ups and downs. So pretty much stabilized. And then in our year now in 2024, we've actually seen it starting to increase again. So for January, it was at 1.842 million. For February, it was 1.884, and last month, March, it was 1.99 million as a median sale price for single-family homes in San Mateo County. Compared to last year, March of 2023, we're actually at 1.75 million. So that's a pretty, substantial increase, and we're going to see what happens because usually March, April, May are our prime selling months. So it'll be good to see if do we continue to see an increase, or does it stabilize a little bit where we're at, or do things change? And I'll go a little and maybe come down a little bit. And so our next slide is on months of inventory, and that has to do with basically you take all the number of homes that are on the market, assume that we're not going to bring any more in, and then we're just going to sell them at the current rate that they're selling. How many months does it take before you run out? Traditionally, 6 months is considered a balanced market, and above that is considered a buyer's market because it's going to take you a long time to run out. And we saw that in the 2008 periods where it was going up to 10 months of inventory. And then if you're below that, then it's considered a seller's market because we're going to run out really quick. That's the whole idea. As you can see on the chart, since about 2012, we've been pretty much hovering in that 2-month range. You see the COVID lockdown line again. The reason why I marked that is because you can see after that, in that 2021 and the early 2022 years, we actually had a big dip of inventory down to more like 1-month levels. And then for 2023, we did see that go up, bump up a little bit to more the 2 month, back to the 2 month. And that's basically where we've been hovering. So for this year in January, we're at 2.2. So you see a little bit of that peak there. A little bit, if you can call it a peak, 2.2, and then it went down to 1.9, and then for March at 1.6. So we're inventory is one of those, I say there are some I words that in fact impact our market. Inventory is one of those big I words, I would say, because that's really been the story for us. I know throughout the country, they've been, after COVID, there was a lot of talk of, low inventory and multiple offers. For us, it wasn't that much of a change because we'd been experiencing that over 10 years, almost 10 years. It did get worse than what we had, but it wasn't new for us. And that is continuing on. We're just seeing not a lot of inventory that's being freed up. One of the things that I've talked about in the past is this whole locked-in effect, economists are calling, which is you have homeowners who maybe want to sell, but they're locked in the sense of, I have a 2.5%, 3% mortgage rate. And now if I were to sell that and buy a new one, I'm looking at more like 6, sometimes 7, 5, even 5. So even if you say 5, it's a double of your mortgage rate. And so that's putting in this lock-in of sellers who maybe are not urgent to move. You're not desperate to move, but and so you're not, because you're going to stay put because at least the mortgage rates are good. And that's helping, especially with inflation, which is my other I word, and I'll be talking about in a bit. So with that, last year, I have to say, most of my listings really were to do with people who had no choice. They were, parents had passed away, different family situations, job relocation, that kind of a situation. Really not as many people who are just trying to move up or move down. It was, and you have that, and we're seeing that just continue to gridlock and be an issue here in our area. The next metric that I always like to cover is days to sell. And this has to do with when you put a house on the market, how long does it take before you actually get into contract, get into an offer that you're willing to accept? So again, you can see here in the 2006, even 2006 through 2012, the number was hovering anywhere between 30 and 50 days. From 2012, that number was hovering around 10 to 20. So it's been up and down since then. You see the red vertical line, the COVID lockdown. My red line is a little bit skewed, but it should be where you see the 0. And that's not because it took no days to sell. It was because the MLS, our multiple listing service, decided to, when the lockdown happened, let's go ahead and pause the counter for days on market. The reasoning was that we were not allowed to show houses. We're not allowed to do open houses. And so, saying that a house is on the market is not really fair when nobody can see it. So that was the rationale behind it. And so we see that 0. But quickly, as soon as, we were freed up to be able to show and continue to sell, came back up to, we see that those numbers around the 10-day range. As I mentioned, toward the latter half of 2022, we started seeing that increase. And so the beginning of 2023, and usually it's January, December, those are the times when you'll see a little bit of the pop up because of the holidays. Things might take a little bit longer to sell. So we did see in January 2023, 29 days. And since then, it's come down again because of the inventory. And so on average, things for March, we're at 9 days to sell. And you can see that really the inventory factor of when a house comes on the market, people are anxious to buy. And so the turnover rate can be high, and very quick. So that's what we're seeing for March. And I think that's what we're going to probably continue to see just as a whole. So this is a new slide that I don't usually bring up, but I thought it's good because I've been talking about inventory, and I just thought it would be useful for people to see, well, okay, low inventory, I get it. So this is a chart that goes back only 10 years. And it shows you can see the peaks and the peaks and the valleys. And that has to do with the seasonal trends, right? So generally in our area, when we get to January, December, no, even February, a little bit of November as well, you're going to see a reduction in the number of new inventory because as we get closer to the holidays, both sellers and buyers they have thoughts elsewhere. You do still have inventory because there are people who just need to sell and the timing works that way. But as a whole, you'll see the bigger portion of our inventory toward, starting from March and April, and then a little bit of dip. And you can see that here as well, a little bit of dip sometimes in the summer months, because again, buyers and sellers are thinking holiday, summer vacation. And then from there, you'll see it go up again in the fall and come down. I thought this was really good to show a picture and not so much just the numbers, but really a picture of we've been having low inventory, as I mentioned, over the last, since 2012. But even compared to that, you can see here, between 2014 and 2021, at least the numbers were somewhat similar, right? With some variations in the way they look, but you're still hovering around 600 new listings in a month for the county. If you look at 2021, that number is similar, but it started coming down. 2022 was even less, just as a trend. And if you look at 2023, that just looking at it, you can tell without any numbers that is significantly lower just for the year. We had our MLS listings, the company actually came out to our office or joined our office meeting to talk about the stats. And one of the things that we were told was that 2023 had the least, as a year, had the least number of total sales for the year, as long as MLS has been recorded for San Mateo County, as long as MLS has been recording data. And I was like, wow, that's how it was feeling during the year. I was feeling it and feeling like at the beginning of the year, especially, it was like, I don't have as good of a pipeline as I usually do by this time of the year. And it was a little bit nervous for me. Thankfully, I ended up okay. But I was talking just in my talks with colleagues in my networking group and otherwise people that I meet, everybody was just feeling like this is a really tough year. And my transaction levels are much lower than what they usually should be by now. So that was a very common conversation that we were having. And so then when I heard that at our last office meeting, that 2023 had the least number of sales for the year compared to any other year since MLS has been recording, that really was jarring to me. Or that was like, yeah, that jives with what I've been feeling. 2024, as you can see, we're on our way up, but we're kind of still at that shoulder, the beginning period. So it remains to be seen where we'll be heading, whether our 2024 will look similar or worse than 2023, or will it kind of pick up and come back to the normal. And so again, inventory, that's a huge, huge word impacting our industry. The other I word that I like to talk about, or I don't know if I like to talk about, but the other I word that I do talk about is interest rates. So this comes from the Freddie Mac website. You can actually go on there if you're curious at any time. Freddie Mac interest rate history. If you Google that, you will come to their website, and you can actually put in. There's an interactive way where you can put in how much data you want to see. I always like to see historical perspective, so I take it back to 1971, which is where they go back, as far as they go back. And you can see here interest rates, always up and down. But toward the right-hand side of this, you can see that effect that I was mentioning, where we were looking at the all-time lows, in 2021, sorry, in 2022, and a little before and a little after, where you would see interest rates average interest rates in the 3 and 4%. I know many people who have mortgage rates even below that. So this is for a 30-year fixed rate mortgage. And as of the date of this chart, which is April 11th, last week, the 30-year fixed rate mortgage was at 6.88%. So not great, but it's better than what we were experiencing last year toward the end of the year. In October, we were looking at rates a little over 8%. So the fact that we've come down by 1% or more is a good factor. And again, in a historical perspective, we do see that there was a time, 1981, 1982, where the rates were at 18%, 17%. So compared to that, it's not as bad. But if you're looking at people and they're comparing to the peak of 3%, and that was the expectation, then you can see why that's a little more difficult to determine, for somebody to think about giving up that rate and going for something higher, or maybe for a new buyer coming in, because yes, in 1981, the interest rates were at 18, 17%, but the prices were significantly lower, right? So that effect was less. So now we have buyers who are dealing with both a high interest rate as well as a high price, a relatively high interest rate as well as a high price. So with this, I thought it would be helpful to bring in more delve into macroeconomic factors and that we've been seeing out there, and why is all this interest rate, what's going on with that. For March, the March CPI numbers that came out last week, there was a gain of 0.4% month over month, which is compared to February, and it rose 3.5% year over year. So compared to March of 2023, our CPI, the national CPI rose by 3.5%. This is compared to estimates of 0.3% and 3.4% respectively. So it is higher. The overall CPI came out higher than expected. The 10-year Treasury yield jumped back above 4.5%. So it had reduced, it had started coming down. And so the numbers were feeling good, but it did jump back up due to that at 4.5%. And going back to the CPI, core CPI, which excludes food and energy, jumped 0.4% month over month and 3.8% year over year, compared to estimates for 0.3% and 3.7% respectively. So what does that all do? Well, basically, all of the thoughts initially when we came into this year, people were talking about, we're going to have some interest rate cuts. Last year, I was hearing people say that maybe we'll have 6 during the course of this year, interest rate cuts, that the Fed will cut their rates, the bank rate, by as many as 6 times. I did hear from one of my colleagues when we were meeting for a holiday party that their company had told them that we're expecting maybe by the middle of the year, we might have even 2% reduction, and we could be in the mid 5s. And so all indicators we're heading in a good direction. The fact that the economy is doing still hotter than expected is not a good thing. And so previous to this last month, or last month, we were actually hearing that, well, maybe the Fed will not lower the rates until June. So we're all looking to June, and that there was a high expectation that that's when we would see the first of the cuts, and then possibly 2 more later this year. With the numbers that came in last week, the expectations now have adjusted, and so there are the majority of folks are thinking that the Fed will not lower interest rates as soon as June, and that it may be either July or August, and we don't know how many more we may even have through the course of this year. What does that do? Well, that's we've been experiencing the last week or 2 in the last week that the interest rates have actually inched up a little bit. The mortgage rates have inched up a little bit, and that's not a good thing. So it's like, well, you don't want the economy to do badly, but you also don't want it to be so hot that the Fed continues to feel like they need to stay conservative and keep the rates where they are, because that does impact the mortgage rates, and that can have an impact on buyers. So going to the buyers, I thought this would be good to share. I think I've shared one of these before, where talking about the buyers are coming. So over the next 2 years, there are buyers out there. So as much as people are talking about, well, the Bay Area, everybody's leaving California, everybody's leaving the Bay Area. Yes, there are people who are leaving the area, but we have such a shortage of housing to begin with that we're still not keeping up. So it's not like, and I don't want people to leave, but I'm just saying we're not having enough people leave to make up for that inventory shortage. And on top of that, the anticipation is that the buyers are coming, that the pool of buyers is going to increase over the next 2 years. In the last 3 years, there have been 3 million marriages, 7 million births through the country, right? And also 50 million people have changed jobs. So and when that happens, they need housing. So with that, and I would add for our area specifically, We did see some amount of people moving away during COVID because they could work remotely. Many of the companies are actually calling the workers back and requiring that you come in at least a few days a week. And so we're seeing a little bit of an influx. Actually, we have been seeing a little bit of influx of people coming back to the area or moving to the area. There are the left-hand side, I have here 40% of potential buyers said that they won't wait for rates to drop. And so if you're looking to buy, the competition is going to be out there. And so that's an interesting metric that you actually have 40% of potential buyers say they won't wait. And I have talked about this before. People have asked me, well, what's the impact of interest rates on buyers? And what I say is, well, right now we've been seeing less of an impact because many of the buyers who are in it now are used to this now, right? When we're in 2022, we had buyers who had been pre-approved for 3%, 4%, 5%, 6%, right? So it was going up, and that was taking them out of the buyer pool, or in terms of qualification, or they just didn't want to pay that. So, and they thought, well, maybe we'll wait for the rates to drop. And so the buyers who are looking at the 3 and 4%, 5%, they are adjusted to a certain degree to go, okay, well, this is where the rates are right now. It makes sense to, because especially in our area, inventory is low. So if you find a house that you like, it makes sense to go ahead and buy it now. And then even if the rate is not quite as low as you'd like it, you can refinance later down the line. We like to use that. One of the phrases we like to use is you date the rate and you marry the home. Right. So the date is something that, the interest rate is something that is temporary and that can be adjusted later down the line, hopefully. Whereas the home is what is permanent and what you want to be staying with. And so that's what's more important to focus on. A little bit of a caveat to that with the interest rates that have increased, that increased last week, over the last couple of weeks, and the fact that they haven't come down, and the fact that the Fed is now it seems likely that they will not be lowering the rates as soon as we'd like. I've actually seen a little bit of a shift in that and seeing buyers more hesitant. And we are seeing a bit of a change in that. And so in the field, like I said, I am seeing a bit of the buyers being more hesitant. We are seeing homes that are selling very quickly still with multiple offers. What I would say is, so we have homes that are selling more quickly with multiple offers. Those multiple offers, first of all, the home needs to be really in a great location, and needs to be ideally in good condition or have a good layout. Buyers are hesitant about having to do work. They can do it, and there are buyers who have the wherewithal to do it, but there is some amount of hesitation to do that because costs of inflation, that I word, has driven costs up, so that if you're going to do work, now you're looking at a significant cost that you have to add on to the price of the home. So if the home is in, good move-in condition or better, and in a good location, then we are seeing the homes that are still selling multiple offers well over the asking price. But even with those, we're seeing, when I say multiple offers, a little bit of a shift. So I have a home that is on the market. We just put on the market last week in Millbrae. It's a beautiful home, has views of the bay in the back, really ideal. We had a lot of activity, and we came in with multiple offers over asking, but we had 4. Whereas I think in previous years, in the previous recent years, I would have expected for a home like this to be more like 10 to 20 offers or even more. So yes, multiple offers, maybe not as much. And so that's where I'm seeing. And then if you have a home where there may be some issue, whether it be the location or the condition, the layout, whatever that may be, we are seeing homes that it's taking a little bit longer to sell, or it's going to end up being having to go through more price reductions. And that's something that we're seeing is more price reductions online. So even though I shared the slides and I'm like, okay, everything's median days on market is 9 days, and the median sale price is almost 2 million, it doesn't automatically mean that that's true for every single home that's out there. There are homes that will sell sooner than that, and there are homes that will just take a little bit longer, take a little more patience, and the expectations might need to be adjusted a bit. And it's interesting because when I feel that, I'm always going, okay, is it just me or is it what other people are feeling? And what's good is that I am part of a couple networking groups, and I'm hearing that from fellow agents as well, where they're saying, yeah, this one went really fast, but there's this one, and it almost seems like the buyers, for whatever reason, we have tons of activity, but they're just not willing to pull the trigger when it comes to submitting an offer. And that's definitely what I'm experiencing personally. And it's nice to be validated by my colleagues out there who are who are very active in the business. And we're always monitoring it because things change. And I think just over the last week or two, that's what I've been hearing, as opposed to even a month ago, where we were just kind of ramping up, and everybody was expecting that things are going to hopefully start loosening up with that anticipation of the Fed, of what the Fed is doing. So the other thing that I will just bring up in the field, and I have talked about it, and I do have videos on it previously, is this proposed settlement between NAR, the National Association of Realtors, with the plaintiffs in the Sitzer Burnett case. And this settlement should be covering nationally what's going on. That settlement has not yet been approved. But within NAR and also our state association, CAR, California Association of Realtors, we're hearing that the two main changes that are results of the settlement that were proposed in the settlement, that they are considering enacting those two changes ahead of earlier, and regardless of whether the settlement is approved as is or not, enacting those changes. And as a reminder, those two main changes are first having the buyers brokers compensation removed from MLS. So the multiple listing service will no longer have that information available on there. And second, before you're able to see a home with an agent, or before we're able to show you a home, we do need to have signed a buyer broker agency form, a buyer broker representation form. So those are changes to look forward to I don't know if I should say look forward to, but those are changes to look ahead to, and that we will be, when that happens, and the details are still being worked out. So when that happens, I will include a little bit of an update here, because I think it does impact all, not just us in the real estate field, but definitely for all of our clients as buyers and sellers. Just to note, and I know in the media there's a lot of hype, just to note, and I think it's important to say, the commissions have always been negotiable. They will continue to be negotiable, and that's something that I think bears some discussion, and I'll probably talk about that in a future video. Talk about that a little more. So to wrap things up, I did want to talk a little bit about our seminars. We had this past week Financial Essentials in Retirement, and special thanks to Dan Young, a CPA, who spoke for us. We had over 40 people attending. You can see a photo here, and in our Millbrae Recreation Center. And we do have the video, so that will be coming soon. And so watch out for that on our YouTube channel. The one key takeaway I would say is, if you haven't turned 65 yet, but if you're getting close, don't be late in terms of filing for your Social Security and Medicare. So don't be late, because there are some implications of that. And then definitely the other key takeaway I would say is, make sure that you're well prepared and planned for retirement. And Dan was offering to speak with and Dan was offering a private session for those people who attended, who wanted to just go over their finances and make sure that they're set up to be healthy in retirement. Our next seminar that's coming up is Investing Wisely in the Golden Years. That will be on May 15th via Zoom. And this has to do with investment options as you go forward, as we're growing older. And maybe if you're managing property, if you have investment property and don't want to do that anymore, what are the options for you? So we'll talk, our speaker, Duncan Eng, will be talking about things like DSTs, the Delaware Statutory Trust, opportunity zones, annuities, possibly long-term care insurance. So a host of things where maybe your investment needs and options and goals may change as we enter older years. And then we do have our continuing session on the real estate and finance in the golden years. So remodeling options for aging in place in July. I'm working on this still, but it will be via Zoom. I have one speaker who is very interested in talking about how you can use ADUs to help you have those remodeling options. but I am looking for another speaker to be able to talk about, if you don't have the option of an ADU, what you can do in your own home to help you stay in place, to live in your existing home longer. And then August 17th, please save the date for that. It'll be Saturday morning, August 17th, 9 to 11. And not 9 a.m. to 11 p.m. That's a typo. So it'll be 9 a.m. To, I think, noon is what I'm thinking. And that will be a whole series of topics where we're talking about the issues of caring for aging parents. So please save the date for that if you're in the area. And then finally in September, we'll have estate planning. We'll be doing basic sessions on estate planning via Zoom, and then an in-person advanced one to talk about all the different nuances of estate planning. What happens if you have multiple heirs and multiple properties, and how do you structure it in a way that you can make sure the heirs don't have to worry about going to court at a later date. So please watch out for those. And then our shredding party on May 11th, that will be in Millbrae at Mills High School from 10 a.m. to 1 p.m. There's a QR code here if you'd like to sign up. It is on-site document shredding and e-waste recycling, and it is free of charge, but we are accepting donations to support Mills High. If you aren't in the area and you'd like to just go ahead and donate to the Mills Annual Fund, you're very welcome to do that. So with that, I'll end my market update and announcements for today. I hope that all of you are doing well and that you're enjoying. We have good weather today that it looks like for now. And I wish you a wonderful weekend ahead and the weeks ahead. And please watch out for, I hope that you will subscribe to our YouTube channel and watch the other videos that we have here, because it's, I'm really happy that we're able to provide the value and the resources. And I'm sharing these videos even with my other agent colleagues, and share them with your clients. And if you are a client of another agent, stay with that agent because they're my friends, and I want to respect those boundaries, but I'm more than happy to provide the information. So thank you so much, and wishing you abundance and joy moving ahead. Bye-bye.